If you had invested $10,000 in the S&P 500 at the beginning of the new millennium, you wouldn't have made a dime for 12 years. Not a single month would have been profitable for you. And at the height of the 2007-2008 crisis, you would be down more than $5,000. You would have to wait until the beginning of 2013 to recover your full $10,000 and even start seeing a bit of profit coming in. And this type of worst case scenario and bad investment timing is exactly the reason I never wanted to invest in the stock market. I always heard people say, if you had invested in the S&P 500 10 years ago, you would have X amount of money right now. And my answer to this was always, well, that's only because the economy has been on a gold rush for the past 10 years. That wasn't true in 2005, for instance. But then I discovered the power of compounding. Disclaimer, none of the insights contained in this video should be considered investment advice. I'm not an expert, I'm not a certified trader, I'm not a professional investor or whatever. I'm just a guy who likes to look at data and analyze it. So what does investing even mean? In this video, we're only talking about investing in the S&P 500, which is a stock market index tracking the stock performance of the 504 largest companies in America, at least the ones that are listed on the stock market. And it is one of the most commonly followed equities indices because it gives a clear picture of what the economy is looking like. We are not talking in this video about picking and buying individual stocks because that's usually a recipe for losing money rather than making any. Everyone I know who handpicks stocks either has poor returns or negative ones. It takes a ton of research, technical analysis, and a very good understanding of how the economy works to make money that way. The S&P 500 also gives you diversification by default, which is a good thing. Here's how its constituents are split by sector or by industry if you prefer. So we can see that it's a bit overweighted in the technology category, and for each industry the index holds only the biggest and top performing companies of that said industry that again are listed on the stock market. It of course doesn't include the private companies. Why is diversification good? It's one of the keys to building wealth over time. You don't want to put all your eggs in the same basket because if one industry goes south and you are all in on that one, your portfolio will lose a ton of value. But if you're also invested in, maybe 8 others that are doing okay, you can minimize your losses, maybe even make up for the losses, and most importantly, you can sleep at night knowing that not all your money is gone. So as I mentioned in the introduction, the strategy is based on compounding, which you've probably heard about before. I had heard about it and I thought I had it all figured out. Turns out I couldn't have been more wrong. Compounding is the process in which the earnings from your investment are reinvested regularly to generate additional earnings. It is the most powerful concept in investing and has made the fortunes of many, mostly those who are able to keep at it for a very long time. Einstein called compounding the 8th wonder of the world and said that he who understands it earns it, he who doesn't pays it. So let's say you invest $1,000 at a 3% return rate for 5 years. You would end up making around $2.5 per month, $30 per year in interest. But if instead of having that extra $2.5 sitting in your account every month, you reinvested it on top of your original $1,000, you would end up with $161 or a difference of over $11. That's not everything. Let's say that on top of investing $1,000 and reinvesting your earned interest every month, you would contribute $100 of your own money every month on top of that. After 5 years, you would have $7,626 in your account, including $626 in accrued interest. And that's a massive difference. And now, let's say that instead of saving in the 3% return savings account, you would have applied this exact strategy to invest in the S&P 500 for the past 5 years. Start with $1,000, reinvest the earned interest every month, and contribute $100 per month. You would now be sitting on $8,304. So clearly, compounding seems to be the simplest and most efficient strategy to make money on the stock market. That being said, testing the strategy on the 2018-2022 timeline like we just did is not enough. This specific time period is considered one of the biggest gold rush in modern economic times. Other than during the pandemic, the economy performed really well and the S&P 500 gained more than 30% during this period. So instead, let's backtest our strategy during one of the worst stock market periods like the one mentioned in the introduction, from 2000 to 2012. Again, little reminder, the S&P 500 didn't return a dime in profit for over a decade, but if you had started with investing $1,000 in it, reinvested your earned interest every month, and contributed $100 every month, you would be sitting on $26,794 at the end of 2012. This is the incredible power of compounding. The one key thing I failed to understand for so long about compounding is that it does very well at minimizing losses when the economy is doing bad, because you can make up for the overall loss in value of your portfolio on a bad month thanks to the monthly contribution. And this way, the more you invest to minimize the losses, the more you make when the economy is going up. And as we're about to see, the faster you recover your losses too. I know it sounds crazy, but it's math. Let's look at another example. So the time frame from 2000 to 2012 also happens to include the worst economic crash of our modern times, the 2008-2009 mortgage crisis. So if we look at a few key metrics here, the S&P 500 lost more than 50% of its value during that period. Your portfolio, on the other hand, would have only lost 42%. The S&P 500 took 3 years and 1 month to recover from its worst loss, which was from February 2009 to March 2012. Your portfolio, on the other hand, would have taken 1 year and 1 month only to recover from its worst losses, from February 2009 to March 2010. That's almost 3 times faster. So the strategy works in bad economic weather as well. So let's now look at a few key takeaways around the strategy. Takeaway number 1, larger monthly contributions have more impact than the large upfront capital. So again, bigger monthly contributions help fight months with negative returns, and they also increase the value of your portfolio faster when the economy is doing great. Consider this: if you had started with a lump sum of $10,000 and invested $100 every month from 2000 to 2012, you would have ended up with $37,852 with compounding interest, which is not bad at all. But if you had started with $1,000 instead, so that's 10 times less, and invested $400 every month instead, 4 times more than 100, you would have ended up with $103,488. Almost a 200% difference. That's insane. Takeaway number 2, the earlier you start, the less you feel the downturns. If you had started with $1,000 and invested the same amount every month from 2010 to right now, your portfolio would have only lost 18% of its value when the economy crashed because of the pandemic, while the S&P 500 lost more than 30% during the same period. Takeaway number 3, if we combine those two components we just talked about, increasing monthly contributions and taking an early start, we pretty much get a rock solid strategy. If you had started with $1,000 and invested $400 every month from 2010 to right now, you would have barely felt the pandemic crash or any kind of economic panic for that matter, and you would be sitting on $135,000. Now that we've covered and back tested the strategy, let's look at a few caveats. There's 2 main ones. That's 4, whatever. So it's fair to say that if all you needed to become wealthy was a few $100s a month and almost no starting capital, a lot more people would be rich, right? Well, not necessarily, because although those are some very basic economic and mathematical principles, they don't teach you this kind of stuff at school. I mean, do you remember your teacher ever mentioning something close to compounding interest? Not only that, as I said, there are 2 main caveats I would like to talk about. Caveat number 1, you can't invest directly in the S&P 500. I mean, you can if you're like a top-notch trader, you work for a bank or an investment fund, and you have access to millions of dollars. We don't have that, unfortunately. So instead, we're gonna need to invest in something called an ETF, which stands for Exchange Traded Fund. This type of fund replicates the S&P 500 investment portfolio, and you can invest in it by buying shares of the fund, like you would buy shares of a normal company. There are a lot of available ETFs out there, and you can find a full list of them at justetf.com. Being based in Europe myself, I picked the iShares Core S&P 500 UCITS ETF. And so what this also means is that depending on the price of one share of the ETF fund you choose, you may not be able to invest the exact amount you had planned to allocate to your portfolio every month. For instance, one share of the iShares ETF fund I chose costs 383 euros as of today when I'm shooting this video. So if you have, let's say, a 200 euro a month contribution plan, you can't even buy one share a month, so it's pointless. This can be fixed by choosing a cheaper fund, so with shares that are less expensive, or by setting aside a little bankroll for your investments. It's pretty simple. Always keep enough cash for a few shares on the account you use to purchase the shares, so your investment account. For instance, keep 1,000 euros at hand. Then, every month, stick to your 200 euro monthly contribution plan and put together the money to buy one share as follows. Use your 200 euro monthly contribution, then add in the interest earned for the month, and then use your liquidity account where you keep a little bankroll to add up whatever is missing to be able to afford a share. Here's an example. If you earned 30 euros in interest for the month, you only need to withdraw 170 euros from your own fund, 400 euros for one share because it increased in price because you made interest, minus your 200 euro monthly contribution, minus 30 euros in interest. So this way it's a constant balancing game, and that's why you'll never get the exact same returns as a strategy I presented in this video, but you will get very close if you stick to the strategy and if you make sure to invest regularly and keep doing it in the long term. Caveat number 2, taxes. So this very much depends on the country you live in, but generally speaking, if you sell shares and make a profit from a trade, you're gonna have to pay taxes on that profit. If you ever want to take a profit and reward yourself with some of the money you've made, you'll have to pay the capital gains tax. In most countries, it hovers between 20% and 30%, but in some countries like Denmark, where I live, it can be as high as 42%, which makes you really consider, do I want to take some of that money out, cash out and pay taxes, or do I want to keep investing in the long term, watch my portfolio grow, increase my paper net worth, and not sell unless I really need the money, and then I have to pay taxes on it. So that's just a little reminder and disclaimer that when I say you would have made $135,000 with this strategy if you had started investing in 2010, yes, but that's in a trading account, right? That's how much your portfolio is worth. If you want to cash out the money and get it into your checking account to buy a car or a house or spend it or whatever, then you're gonna have to take it out of your trading account and pay taxes on that $135,000. So just something to keep in mind, pay your taxes. It helps people, it helps you pay your taxes. Or if you don't like taxes, move to a country where they don't have taxes. But yeah, if you live in a country where you gotta pay taxes, you gotta pay taxes. Conclusion: the best day to start investing in the S&P 500 was always yesterday. But especially with the current economic context, people who have never put their money to work before, like me, well, we folks have a rare opportunity to make up for the wasted time. The S&P 500 is down more than 25% since the beginning of the year. That's at least as I'm shooting this video, and that's the biggest long-term drop in over a decade. For people like us who are looking to invest in a long-term wealth and ride the wave out of the recession, which will happen eventually, the economy works in cycles. For those people, this means that stocks are on discount. And the best and fastest way to seize this opportunity is to invest in the S&P 500. Thanks a lot for watching this video. As always, it means the world. Don't forget to like and subscribe if you haven't already. And if you enjoyed the video, you can also drop a comment if you like it. Let me know what you thought of the video. Don't forget to also check out my 75 people who do interview series. Tons of insights on productivity, self-improvement, but also mindfulness, money management. Check it out. It's great. I had a blast making it. And you get a discount code because you watched this video. Thank you so much. That's it. Keep up the great work. Thanks so much for watching. See you next week. Stay healthy. Enjoy the journey you're on.